Business Valuation and Corporate Restructuring. Chapter 3. Valuing Different Types of Businesses. Valuation Challenges for Startups. Valuation challenges for startups can be significant due to several factors. 1. Limited financial history. 2. Uncertain market potential. 3. Unique business models. 4. Intellectual property and intangible assets. 5. Founder dependence. 6. Market sentiment and timing. 7. Negotiation dynamics. Explanation. 1. Limited financial history. Startups often lack a substantial financial history, making it difficult to assess their worth based on traditional metrics like revenue and profits. Investors may need to rely on projections and estimates, which can be subjective and speculative. 2. Uncertain market potential. Startups operate in dynamic and uncertain markets, where the potential for growth and success is often unclear. Estimating the addressable market and predicting future demand can be challenging, impacting the perceived value of the startup. 3. Unique business models. Many startups introduce innovative and disruptive business models that may not have direct comparable in the market. This uniqueness makes it difficult to benchmark their value against existing companies, leading to valuation ambiguity. 4. Intellectual property and intangible assets. Startups often possess valuable intellectual property and intangible assets, such as patents, technology, or brand recognition. However, valuing these assets accurately can be complex and subjective, particularly if their market potential is uncertain. 5. Founder dependence. The success of a startup may heavily rely on the capabilities and vision of its founders. Investors may struggle to evaluate the extent to which the startup's value is tied to its founding team and assess the risks associated with founder dependence. 6. Market sentiment and timing. Valuation can be influenced by market sentiment and timing, with factors like investor appetite for risk, industry trends, and macroeconomic conditions playing a significant role. A startup's valuation may fluctuate based on prevailing market conditions, making it challenging to determine its true worth. 7. Negotiation dynamics. Valuation is often a result of negotiations between startups and investors. Both parties may have different perspectives on the startup's value, leading to negotiation challenges and potential discrepancies in the final valuation. To address these challenges, startups and investors may employ various valuation methodologies, such as discounted cash flow analysis, comparable company analysis, or the venture capital method. However, even with these methodologies, accurately valuing startups remains an inherently uncertain and subjective process. Valuation for early-stage companies. Valuing early-stage companies presents unique challenges due to their limited operating history, uncertain future cash flows, and higher risk profile. Here are some key factors and approaches to consider. 1. Market potential. 2. Technology and intellectual property. 3. Founder expertise and team. 4. Milestones and traction. 5. Comparable transactions. 6. Discounted cash flow, DCF, analysis. 7. Market multiples. 8. Risk factors and discount rates. 9. Stage-based valuation models. 10. Negotiation dynamics. Explanation. 1. Market potential. Assessing the market size and growth potential of the industry in which the company operates is crucial. Early-stage companies with significant market opportunities may command higher valuations, especially if they have a compelling value proposition and scalable business model. 2. Technology and intellectual property. Evaluate the uniqueness and defensibility of the company's technology, intellectual property, or proprietary assets. Strong intellectual property can enhance a company's valuation by providing a competitive advantage and barrier to entry for competitors. 3. Founder expertise and team. The experience, skills, and track record of the founding team are essential considerations. Investors often place value on the capabilities of the founders to execute the business plan and navigate challenges effectively. 4. Milestones and traction. Achieving key milestones and demonstrating traction in terms of customer acquisition, product development, or revenue growth can positively impact valuation. Early validation of the business model through customer feedback or pilot programs can de-risk the investment and justify a higher valuation. 5. Comparable transactions. Analyzing similar deals within the industry or sector can provide valuable benchmarks for valuation. However, finding direct comparable for early-stage companies can be challenging due to their uniqueness and stage of development. 6. Discounted cash flow (DCF) analysis. While DCF analysis is commonly used for valuing mature companies, it can also be applied to early-stage companies by forecasting future cash flows and discounting them back to present value. However, projections for early-stage startups are inherently uncertain, requiring conservative assumptions and sensitivity analysis. 7. Market multiples. Multiples based on comparable company analysis or precedent transactions can be applied cautiously to early-stage companies. Adjustments may be necessary to account for differences in growth prospects, risk profile, and stage of development. 8. Risk factors and discount rates. Early-stage companies are inherently riskier. Investments, warranting higher discount rates to account for the uncertainty and potential for failure. Investors may apply risk-adjusted discount rates or use risk premium methodologies to adjust the valuation accordingly. 9. Stage-based valuation models. Some valuation models, such as the venture capital method or the risk-adjusted return method, are specifically tailored to early-stage companies. These models consider the expected return thresholds of investors and the associated risks at different stages of the company's growth. 10. Negotiation dynamics. Valuation negotiations are influenced by factors such as investor demand, market conditions, and the bargaining power of the founders. Early-stage companies should strike a balance between securing sufficient capital and minimizing dilution of equity. Ultimately, valuing early-stage companies requires a combination of art and science, with investors and founders needing to make informed judgments based on available information and risk assessments. Collaboration between investors and entrepreneurs, transparent communication, and alignment of interests are critical for reaching mutually beneficial valuation terms. Valuing mature and established businesses. Valuing mature and established businesses is often more straightforward than valuing startups or newer ventures because there is typically a track record of financial performance and established market presence to analyze. Methods used to value mature businesses. 1. Income approach. 2. Market approach. 3. Asset approach. 4. Adjusted book value. 5. Multiples analysis. 1. Income approach. This method values a business based on its ability to generate income in the future. The most common technique under this approach is the discounted cash flow (DCF) analysis, where future cash flows are estimated and discounted back to their present value. This method requires making assumptions about future performance and risk, including growth rates, discount rates, and terminal values. 2. Market approach. This method compares the business to similar companies that have been sold or are publicly traded. Comparable company analysis, CCA, and precedent transaction analysis, PTA, are two common techniques under this approach. CCA involves identifying publicly traded companies with similar business models, size, growth prospects, and financial metrics, then analyzing their valuation multiples, such as price-to-earnings ratio or enterprise value-to-revenue ratio, to determine a valuation range for the subject company. PTA involves examining the sale prices of similar companies to derive a valuation multiple or range. 3. Asset approach. This method values a business based on the value of its assets, both tangible, such as real estate, equipment, and inventory, and intangible, such as intellectual property, brand reputation, and customer relationships. The two primary techniques under this approach are the going concern value and the liquidation value. The going concern value estimates the value of the business as if it were to continue operating, while the liquidation value estimates the value of the business's assets if they were to be sold off individually. 4. Adjusted book value. This method starts with the company's book value, the value of its assets minus liabilities, and then adjusts it to reflect the fair market value of its assets and liabilities. Adjustments may be made for factors such as undervalued or overvalued assets, unrecognized intangible assets, or contingent liabilities. 5. Multiples analysis. This method involves applying industry-specific valuation multiples, such as EV, EBITDA, P/E ratio, or price-to-book ratio, to the company's financial metrics, such as earnings, EBITDA, or book value, to derive a valuation range. These multiples are often derived from comparable company analysis or precedent transaction analysis. Ultimately, the choice of valuation method depends on factors such as the nature of the business, the availability of data, the industry dynamics, and the preferences of the valuator or potential buyers, investors. It's often advisable to use multiple methods to triangulate a reasonable valuation range and consider the strengths and weaknesses of each approach. Consulting with financial experts or business valuation professionals can also be helpful in navigating the complexities of valuing mature businesses. Valuation of distressed companies. Valuing distressed companies can be challenging due to the uncertainty surrounding their financial health and future prospects. Methods used to value distressed companies. 1. Asset-based approach. 2. Market-based approach. 3. Income-based approach. 4. Liquidation value. 5. Option-based models. Explanation. 1. Asset-based approach. This method focuses on the company's tangible assets such as property, equipment, and inventory. The valuation is based on the liquidation value of these assets, assuming the company is forced to sell them quickly. However, this method may undervalue the company if it has valuable intangible assets or if the market value of its assets exceeds their book value. 2. Market-based approach. This approach compares the distressed company to similar companies that have been sold or are publicly traded. Comparable transactions or market multiples, such as price-to-earnings ratios or enterprise value-to-revenue ratios, are used to estimate the company's value. However, finding comparable companies can be challenging, especially if the distressed company operates in a unique industry or has few competitors. 3. Income-based approach. This method estimates the present value of the company's future cash flows, taking into account its distressed financial condition. Discounted cash flow (DCF) analysis is commonly used for this purpose, where projected cash flows are discounted back to their present value using a discount rate that reflects the company's risk. However, forecasting future cash flows for a distressed company can be highly uncertain, and choosing an appropriate discount rate can be challenging. 4. Liquidation value. This method estimates the value of the company's assets if it were to be liquidated. It considers the company's liabilities and any costs associated with the liquidation process. While this method provides a conservative estimate of value, it may not capture the potential value of the company as a going concern. 5. Option-based models. Option pricing models, such as the Black-Scholes model, can be used to value distressed companies by treating the company's equity as a call option on the underlying assets. This approach considers the value of the company's assets and liabilities, as well as the volatility of its stock price. However, option-based models can be complex and may require significant assumptions. When valuing distressed companies, it's essential to consider the specific circumstances of the company, including its industry, competitive position, and the reasons for its distress. Additionally, seeking input from financial advisors, restructuring professionals, and industry experts can help ensure a more accurate valuation. Valuation in specific industries. Valuing distressed companies in specific industries often involves considering industry-specific factors and challenges. Here are some examples of how valuation methods may vary across different industries. 1. Manufacturing. 2. Retail. 3. Technology. 4. Real estate. 5. Energy. Explanation. 1. Manufacturing. In manufacturing industries, asset-based valuation methods may be more common, as companies typically have significant tangible assets such as machinery, equipment, and inventory. However, the value of these assets may depreciate quickly, so adjustments may be needed to reflect their current market value accurately. Additionally, industry trends, technological advancements, and competitive pressures can significantly impact the company's valuation. 2. Retail. Retail companies often face challenges related to changing consumer preferences, competition from e-commerce, and fluctuations in consumer spending. Valuing distressed retail companies may involve assessing the value of their physical stores, inventory, brand reputation. Market-based approaches, such as comparing the distressed company to similar retailers that have undergone restructuring or bankruptcy, may be useful in this industry. 3. Technology. Valuing distressed technology companies can be complex due to the rapid pace of innovation and the importance of intellectual property and intangible assets. Income-based approaches, such as discounted cash flow analysis, may be more appropriate for technology companies, as they focus on the company's future growth potential and cash flow generation. Additionally, considering factors such as product development pipelines, patents, and strategic partnerships is essential when valuing distressed technology companies. 4. Real estate. Distressed real estate companies may require specialized valuation techniques, such as discounted cash flow analysis for income-producing properties or comparable sales analysis for development projects. Factors such as location, property condition, market demand, and financing terms can significantly impact the valuation of distressed real estate assets. Additionally, considering the potential for property repositioning, redevelopment, or lease restructuring may be necessary when valuing distressed real estate companies. 5. Energy. Valuing distressed energy companies, particularly those in the oil and gas sector, may involve assessing factors such as commodity prices, production costs, reserve estimates, and regulatory environment. Asset-based valuation methods, such as discounted cash flow analysis or net asset value analysis, may be common in this industry due to the importance of reserves and infrastructure assets. Additionally, considering factors such as environmental liabilities, hedging strategies, and geopolitical risks is crucial when valuing distressed energy companies. In all industries, it's essential to consider the unique characteristics and challenges facing the distressed company when performing a valuation. Consulting with industry experts and leveraging industry-specific data and benchmarks can help ensure a more accurate valuation. Valuing distressed companies in specific industries such as technology and healthcare requires considering industry-specific factors that can impact the company's financial health and future prospects. Here's how valuation may differ in these sectors. Technology industry. 1. Intellectual property, IP, assets. 2. Revenue growth potential. 3. Customer base and contracts. 4. Market trends and competition. Explanation. 1. Intellectual property, IP, assets. Technology companies often possess valuable intellectual property, including patents, copyrights, and proprietary technology. Valuing these assets accurately is crucial as they can significantly contribute to the company's overall value. 2. Revenue growth potential. Technology companies are often valued based on their potential for revenue growth, especially if they operate in high-growth sectors such as software as a service, SaaS, or cloud computing. Assessing the company's technology, market positioning, and ability to innovate is essential for estimating future cash flows. 3. Customer base and contracts. The quality and stability of a technology company's customer base and contracts can impact its valuation. Long-term contracts with recurring revenue streams can provide more stability and predictability to cash flows, whereas a high churn rate or dependence on a few key customers can increase risk. 4. Market trends and competition. Understanding market trends, competitive dynamics, and technological disruptions is critical for assessing a distressed technology company's future. Prospect. Changes in technology, consumer preferences, or regulatory environment can significantly affect its valuation. Healthcare industry. 1. Regulatory environment. 2. Intellectual property and R&D pipeline. 3. Market access and reimbursement. 4. Product portfolio and competitive positioning. Explanation. 1. Regulatory environment. The healthcare industry is highly regulated, and changes in regulations can have a significant impact on companies operating in this sector. Valuing distressed healthcare companies requires assessing their compliance with regulations, potential legal liabilities, and ability to adapt to regulatory changes. 2. Intellectual property and R&D pipeline. Similar to the technology industry, intellectual property and research and development, R&D, pipeline play a crucial role in valuing distressed healthcare companies. Patents, drug candidates, and clinical trial data can significantly influence the company's future revenue potential. 3. Market access and reimbursement. The ability to commercialize healthcare products and access reimbursement from payers such as insurance companies and government agencies is essential for healthcare companies' financial viability. Valuation should consider the company's market access strategies, payer relationships, and reimbursement landscape. 4. Product portfolio and competitive positioning. Assessing the company's product portfolio, competitive positioning, and differentiation from competitors is critical for estimating its future cash flows and market potential. Factors such as market share, pricing power, and barriers to entry can impact valuation. In both industries, conducting thorough due diligence, understanding industry-specific risks and opportunities, and leveraging industry expertise are essential for accurately valuing distressed companies. Additionally, working with financial advisors or industry specialists familiar with technology or healthcare sectors can provide valuable insights and perspectives during the valuation process.